can reverse engineer that math to say, all right, well, at $500 a door, I got to own 20 of them, and this is how I get there, right? But we always want to take time to educate them on how you truly build wealth in rental real estate. And what I've learned in my experience over many years of investing and building an extremely large portfolio is that it's all the other things that really factor into building net worth. So I is for income, D is for depreciation. That's extremely important to take into consideration. Depreciation and all the other tax benefits. We run an 8-figure business, and every single year, our goal is to buy enough rental real estate, run accelerated depreciation, and offset all of our active income and create losses from there. But we're earning a significant amount of money, both from our active business and our real estate, but we're offsetting that. I mean, taxes are the highest expense we're all going to pay in our lifetime, hands down. And that's an easiest way to give yourself an immediate raise, to pay less taxes. Real estate is a beautiful tool to do that. So D is depreciation, E is equity as you're building up. So
welcome to today's episode where we delve into the quest for financial freedom. Achieving financial freedom unlocks a world of possibilities: the liberty to manage our time, the choice of where to live, the means to maintain or improve our health, and the capacity to give back generously. Among the myriad of paths to financial liberation, real estate stands out as a proven avenue, creating more millionaires than any other investment strategy. Today, we're zeroing in on turnkey properties. And guiding us through the ins and outs of turnkey investing, we're joined by Zach, a seasoned expert in the field. Zach, it's great to have you with us.
hey, Ravi, I'm so excited to be here. Thanks for having me on.
Absolutely. So let's start with you telling us a little bit about yourself, what's your background, and how you came to where you are today.
Yeah, so I came from a background actually nothing to do with real estate, as many of us that are full-time investors tend to be. But I do have a background in healthcare. So my wife and I are optometrists. We met in school in Oregon. I was on an HPSP scholarship, so I joined the Air Force after graduating. I practiced optometry for 7 years in the Air Force. Moved out to Denver, Colorado, which is where we still reside today. We owned and operated our own private practices, but throughout that entire time, actually when I was a young captain in the Air Force, that's where I started investing in rental real estate, Ravi. So I was very interested in just, learning how to make smart investments, as many people probably started. I read Rich Dad, Poor Dad, right? That kind of lit the initial fire of like how to think about investing and money. The first house I bought was a duplex, rented out half, lived in the other half. Used a VA loan, putting zero money down. I was like, wow, this concept is cool because I get to live for free. And then I moved out of that house, and now it's a positive cash flowing property, and then continued to buy more and more real estate. This was about 15 years ago when I bought that first duplex. And since then, I've not taken a single year off. Every single year I bought more and more rental real estate. But there was a pivotal moment that really changed the trajectory of our lives, really, and certainly our business trajectory. And that was where we learned to strategically invest in rental real estate in areas where we didn't live. And this was because we saw a better opportunity. We were able to scale and diversify our portfolio quicker. We were able to invest in areas that had the best returns, both from appreciation and cash flow, and ultimately build a well-diversified portfolio. And so that allowed us to ultimately retire from our career paths in optometry. We don't practice today except for in a volunteer setting. We were still licensed, but we were able to not only replace, but well surpass our income as optometrist, following just the fundamentals of investing in the nation where the best opportunity was. That led to the foundation of our company today, Rent to Retirement, which is the nation's leading turnkey investment company, assisting other people to do the same thing, because we had a lot of friends and family and colleagues that were like, hey, we see the success that you're having in rental real estate. We're busy professionals. We live in expensive areas. Whatever the case is, we're learning how to invest in rental real estate. Like, can you help us? And so we certainly found the demand for helping other people to follow the same path. Fast forward to where we're at today. We offer turnkey investment properties where we identify the best locations throughout the U.S. We have our teams and systems in each one of these areas to allow individuals access to invest in the best deals across the country without having to handle all the day-to-day operations. So we're across 12 different markets. We do about 800 to 1,000 doors a year, and just love the real estate thing. So that's about as consolidated as I can give you on my story.
Well, that's great. I mean, there are a lot of parallels in your story and mine, in fact, because also medical background. Also, my first property that I moved in was a duplex with like a basement that we rented out to. So we rented 2 units and lived in one. And then also we bought properties every year. Though where I deviated from your path is that we ended up going the multifamily route, where we were buying larger apartment complexes and getting investors to invest. So, if you invest with us, you're investing on the passive side. You're investing as an LP investor. But what you're talking about is investing on the active side. So can you describe the difference between the two, and then also just describe what a turnkey property is?
Yeah, certainly. So, we help people build their own portfolios in rental real estate. And this is, while it would probably be a little bit more active than, say, like a syndication or something to that degree, we are still more on the spectrum. We tend to be more on the spectrum of the passive side to the degree that you can be, while actually owning physical rental real estate. And so we're not raising capital from investors to work on larger projects. We're helping them build their own individual portfolios, which is just, of course, another way to invest in rental real estate, where you're 100% the owner of the asset. Now, we have all the teams and systems in place to handle management. We started at a very high level on a macroeconomic scale to identify the best markets throughout the country where we see there to be opportunity. We want to factor in all the things that are important to build a sustainable business model long term. You need to be in areas that have landlord-friendly legislation, low taxes, future population, economic growth. I think all the important economic indicators to point to an area where you're going to have a strong rental future in that area. So we go into those markets, we build our own portfolio, build our teams and systems, and we've developed these over the years. I mean, this doesn't happen overnight, right? I mean, we've built our own portfolio in these areas where someone can come in and we guide them through which markets are best to invest in, which properties fit their goals, and then they are actually buying the property. And so a little parallel to, say, the syndication route, in this route, you're 100% of the owner. So you're taking out the debt if you're using leverage, which does, potentially have additional benefits for you. You're able to leverage your capital to buy more real estate. You have 100% control over it. We will handle the operational side of everything, but you're building your own portfolio. In addition to that, you still need to, though, manage your manager, right? This is probably some more involvement, but we do have the systems in place where this doesn't have to be buying yourself another job, actively managing properties, especially as you're scaling, across different areas. When we talk about turnkey, what we mean is that a property has been either fully renovated or newly built. The vast majority of what we focus on is new construction. That's about 80% of the properties we do. We love new construction because you get a brand new built house. You have very predictable income. You attract quality tenants. You have the best appreciation, both in rents and home prices over time, in addition to, just having builder warranties and things like this on the property. So we focus on the Midwest and the Southeast. The Southeast is where we do a lot of construction in markets like Texas, Alabama, Florida, Carolinas, Georgia. And then we also work in the Midwest like Missouri, Indiana, Ohio. Those would be some of the markets that we focus on. So this is a way for someone, if they wanted to maybe be a little bit more hands-on or actually have actual property ownership, could be certainly a way for them to get in and expand their portfolio.
Okay. And those markets that you mentioned, do you focus on specific cities in those markets or MSAs?
Yeah, we certainly do. I mean, we do extensive research to identify, we want to be in the path of progress, areas that are growing. There is a national housing shortage in the US. Actually, today I was just presenting on another podcast about this earlier this week, but we have a undersupply of 7.2 million houses in the US that we need. And a large portion of those are geographically located in the Southeast. So not only do we have an affordability issue, but we also have a huge undersupply of housing. All the builders combined can't build enough houses to meet the demand. And so we want to be in those areas where there's an undersupply. But certain areas we're definitely, we can talk about specific areas as well. Like, for example, in Alabama, we want to be around Huntsville and Birmingham, or around the coastal area. In Florida, we like Southwest Florida and Central Florida. Often what we'll do is actually focus on areas that are outside of a large metropolitan area, sometimes secondary markets. To be specific, one area we focus on would be Polk County, right outside of Orlando, where you can buy a single family house for, say, $300,000 that's renting out at $2,500 to $2,600 a month to produce positive cash flow. That same house, say, in the metropolitan area of Orlando, could be $1 million, but it's only renting for, call it $3,000 to $4,000 a month. So the opportunity is better just outside. We're still commutable to that area, but that's just one example of some of the things we focus on.
And how do you do your market analysis? How do you decide which markets make sense?
You have to look at trends, right? I mean, it's not rocket science. Anyone can pull up information based on census data. And so we want to look at areas where there's, like, look at the supply and demand, look at the inventory supply, look at population shifting, right? Like Florida and Texas, you keep hearing about people constantly moving to Florida and Texas for one reason or another. Florida had over 2% population growth, which was the highest out of any state last year. And so we're looking at those trends in general, but also where are the major employers coming in? Where are these Fortune 500 companies developing jobs in these areas? And then also coupling that with things like where are we investing where the legislation is more landlord friendly, so we don't have to deal with a tenant that can possibly squat in the house for a year or something to that degree, right? We want to be in areas that are business and tax friendly for investors because we know that's where you get the best benefits and allows you to build a sustainable portfolio long term. So it's multifactorial. On the microeconomic scale, we have people in each city that are attending city planning meetings. Like, where are the transportation and jobs and plants being developed? We're seeing a big shift right now just with where we're at economically, and there's a lot of opportunity in some of these areas just affordability wise. We see a big shift for people moving for affordability purposes, but there's a lot of metrics that we look at, and we do share all that data with our investors.
Okay, that makes a lot of sense. So if I were an investor and I am interested in investing outside my current market, you would present the data to us showing how much a property would cost, what the potential mortgage payments plus the other additional operational expenses would be, and then how much you could get in rent, and what is your return on investment, what's your cash flow. That's all presented to every investor in every different market. Is that how it works?
Yeah, absolutely. I mean, we know we have established teams in these areas, so we know exactly what rents are going to be. Many of these properties are already completed and rented, so you're cash flowing from day one. But we take it a step further from there as well, Robbie. We look at things like, and this is tailored towards the individual's goals. A big part of our business plan is to help people build successful businesses. I understand that many of your listeners are high-income earners, probably medical doctors, right, that are paying exorbitant amount of taxes, like we all tend to do. Beautiful thing about real estate is the most tax efficient investment that you can make. And so we really want to craft an individual strategy and plan with each person to identify not only where the best locations are for them to invest, but how do they get the max tax benefits? For example, and we operate with short and midterm rentals. The majority of what we do is long term. We do mainly single family and small multifamily, but sometimes I'll use an example. I think this will be beneficial. We had an investor the other day that closed on a few short term rentals with us, where he was a doctor and his wife was an attorney, high income earners. This is their first investment property they'd ever purchased, so they couldn't go down the path of like qualifying for a real estate professional status where they take accelerated depreciation. However, there is a short-term loophole where someone could come in and you need to self-manage short-term rental the first year, and then you can simply turn it over to management the year after if you don't want to continue to self-manage it. But that allowed them, they bought a $300,000 property in the Southeast. It was new construction. We gave them all the tools and resources they need to furnish the house, to self-manage it from a distance as a short-term rental for a few months. And then they turned it over to management, but that allowed them to take accelerated depreciation, where they ran a cost segregation study on that property and had about $100,000 of tax write-off that they were able to write off from their medical and their legal income, where they're in the highest tax bracket, right? So that equated to probably around a $40,000 tax deduction in year one just from buying that property. And I want to take this, without going too deep down a rabbit hole, I want to take this just one more level here, if you'll allow me. But we had a creative lending opportunity where they can buy an investment property with as little as 5% down. This was through a local credit union. This is not like a house hack. They're not having to live in this. This is a true investor loan, a portfolio loan. They bought this property with 5% down. So they literally were into the property less than $20,000. They bought a brand new construction property that they had over double their down payment in tax deductions. That will still then they'll turn over to management the year after, and they'll continue rent. So I know I went deep into a specific scenario, but I just wanted to illustrate like some of the creative ways we work with investors to maximize tax benefits and the local market to help them, ultimately accomplish their goals on whatever those are.
Right. That's a very interesting strategy. And in fact, I guess the cost would be the 5% down, which you can also get with an FHA loan as well. And I think there's some, and I read recently, I heard, and you can probably expand on this, is that in FHA loans for 2 to 4 unit properties, there is legislation that allows 5% down as well. Is that correct?
Yeah, and you can actually go down to 3.5. But what we were talking about in this scenario, this is not a FHA product, because FHA is for a primary residence, which you certainly could say buy a single family or say a fourplex and live in one unit, rent out the other 3 units. The loan structure that I was referring to is a portfolio loan with a local credit union. It's a true investor loan. So you're buying true investment properties. You can buy multiple of them where you can put as little as 5% down. You don't have to put 5% down, right. But this is a portfolio loan. So it's a different loan structure. It's not FHA. This is an investor loan. It's amortized 30 years. It's a 10-year term. There's no PMI or prepayment penalty. So the point in all of this, though, is there's different loan structures out there that we try to assist our investors with using if it meets their goal. I would say the vast majority of our investors use conventional financing because they can easily qualify that, where they are putting the normal 20 to 25% down on properties. But leverage is key, right? I mean, for someone that has high income, that might be something that they want to think about.
So, okay, so we spoke about markets and how you analyze markets. And, if people want to go more in depth in that analysis, they could certainly contact you. You talked about investing mostly in new properties, which makes a lot of sense because you don't have to worry about deferred maintenance or improvements or things like that, especially if you're investing in areas outside your geographic region, because I imagine doing those types of improvements in a older property obviously would be much more time consuming and difficult versus, a brand new turnkey investment. You also mentioned furnishing because that's, vitally important. How does that work?
So, and I did go down in that tangent of a short-term rental. The majority of what we do are long-term rentals, where we have a brand new house, single family or small multifamily that's already been completed. Often it's already leased. The tenant furnishes it themselves in a long-term rental. So you're just buying a normal investment property. This is a normal transaction going through the financing and due diligence of appraisals, inspections, and the whole 9 yards. But if you wanted to be more creative or operate in, say, the midterm or short-term space where you could take potentially that same single family house that would produce a decent, call it a 8 to 10% cash on cash return as a long-term rental, you do have the potential to, furnish the house and operate it as a short-term rental where you could potentially double that income. That would have some additional furnishing costs up front. We see about $10 to $12 a square foot for furnishing. We have companies that will furnish houses. We will manage for you if you want, even on the short-term basis, or if you're trying to be like the last investor couple I talked about and self-manage it specifically so you can take the accelerated depreciation and then turn it over to us. That's an option as well. But the vast majority of what we do are long-term rentals where it's just very typical. These are areas, just long-term tenants. You get someone that signs a 1 to 2 year lease and has consistent cash flow while you're building equity through the house and in other ways.
Yeah. So, when you talk about property management, it reminds me of what I did back in the day where I would, and you probably did the same thing, you'd self-manage for a while until you built up enough units where it made sense to get someone else to manage. And, that was back when I was just starting. And I remember this one incident where it was like 3 a.m. I was sleeping. I was renting these units. I lived in the top unit, rented the bottom two. I got a call from the tenant saying her toilet was broken and leaking. So I'm like, are you kidding? Okay, it's 3 a.m. So I go downstairs. Luckily it's right downstairs. I go downstairs and I see this drunk guy like passed out in the bathtub, and the toilet tank was completely off kilter and it was just leaking outside. And I laugh now, but I was so annoyed and upset at the time. And this girl was obviously inebriated as well. So and it was like experience after experience with that type of property. With that property management type situation, I realized very soon that it would benefit me to get a good property manager to manage all this stuff. So the question to you is, you mentioned property management, but how can people avoid that thing, especially when you're managing from distance? How do you avoid those issues? Because even the best property managers, especially when you're talking about these smaller properties, they don't do everything for you. Often they don't. So how do you avoid that?
Yeah, so much. And we've certainly all been there, right? Self-managing and finding out very quickly that that's not necessarily the highest and best use of our time. And I think that's an important thing to understand too. I mean, management, like we always tell investors to approach this like a business, right? As you should, especially if you're a high income earner, like your time is not best spent managing the properties, and that creates sometimes even a negative taste for real estate because you're having to deal with those things, and it's just not fun. But really, if you're approaching this like a business, having management is just a piece of the puzzle that allows you to focus your time on your family, your active business or company and occupation, as well as your real estate business. How your highest and best use of time is how to scale, right? How to effectively make the choices that make the most impact, like how to build a strategy and take the tax advantages and all these things about building a business. So having management in place is really what allows us to be more passive and allows you to scale over time to ultimately achieve your financial goals, because it's a scalability game, right? I mean, if you want to have substantial passive income in rental real estate, you need to have the ability to scale with good teams and systems in place. Our managerial teams that are in hyper local to each one of these areas they have systems to follow, right? This is a business. They do everything. It is full scope management. What they won't do is likely pay your mortgage. I do a lot of commercial property investing, and we have a whole diversity of things in our own personal portfolio. But you still need to manage your manager and make sure that they're doing their job, right? And that could be as simple as a monthly check-in just to see how your properties are performing. But ensuring that the managerial team has a system, how to handle these, how they vet tenants, how they do accounting. Do they have accounting software? What is their policy on late fees and evictions? Like, this is housing, this is real estate. You're always going to be dealing with tenants. This is a people business, but having management that has a proven track record to confidently manage the properties in a systematic approach is really what it's about. But also, you need to have some oversight, right? And if they aren't doing a great job, then you need to correct them or possibly find new management. But our team facilitates. We do management in some markets, but the markets where we don't, we have local teams that we've partnered with that we've thoroughly vetted and that have also adopted some of our best practices that we've seen nationwide. And so the goal would be to be an owner that doesn't have to deal with these things and can feel confident that management is doing everything, because they are full scope. But that is part of real estate ownership, right? Yeah. So that's part of actually owning property.
Right. And typically in multifamily management companies charge anywhere from like 3 to 7%, at the very high end. But typically what we get is around 3.5% per year in terms of in total rental income and revenue. What about in your space? How much do they charge?
On the residential, there's certainly economies of scale, right? If you're growing a larger portfolio, you have the ability to reduce fees. On average, about 6 to 8%, I would say what would be average for residential. Industry standard is 10%, in most markets on a residential property. We're able to reduce that some for our investors to give it back to them. But yeah, I mean, you're talking probably the difference is managing hundreds of doors versus, a handful of a small portfolio. But that's typically what we see.
Okay. And 68% is actually quite good. I mean, when I've looked in my personal small portfolio in Washington, D.C., I was getting quotes for, 10%, 11%, 12%. Typically, that's how much it costs in that area. And also, when you think about management, you mentioned the management is a full service company. What about when you have issues with neighbors and things like that? Because this is, you think about this as maybe a one-off thing, but it happens not infrequently where you have a neighbor that's like causing issues, and then your tenants complain, and you need to just talk to that neighbor or figure out some kind of workaround. Does your management company handle those types of issues?
Yeah, certainly. Look, well, I mean, we could go through a whole laundry list of different issues, right? Like, This is rental real estate. There's always something, right. But the key is to have a team that has systems in place that can address anything that comes up, right? Like, if we have to evict tenants, and that's no different from, say, a large multifamily, right, or whatever the case is. Like, management is management. They need to address all those issues, right? I had to recently evict a commercial tenant that was on a 10-year lease, and managed the same thing. Management just handled that, right? They handled, they had the legal. I had to participate and sign documents and give approval, but I wasn't in the day-to-day of that. So it's just about having a managerial team that is equipped and has the, I guess, the business infrastructure to handle those things when they come up.
Okay. And let's just talk a little bit more about risk mitigation, because you mentioned several things already. You mentioned, number one, a newer property, so you don't have the risk of, things failing as quickly. Number two, you mentioned property management. Number three, you mentioned, the proper markets. Anything else you guys do to mitigate risk?
Yeah, I forgot to mention this previously when we talked about when you were sharing some of your tenant horror stories, and I have plenty of them as well. But also just being in better neighborhoods. Sometimes when people hear the word turnkey, that's a buzzword. That's a very broad term. And if you've had an experience with turnkey in the past, sometimes your mind immediately goes to like an older rehabbed house in the Midwest that's low income area, looks good on paper, but the performance of it isn't exactly what you anticipate. And, there are certain companies that sell that type of product. We focus on new construction in upper B and A class areas. So we attract quality tenants. Our average occupancy time is just under 4 years, and so by having a brand new built house in a quality area, it attracts the best quality tenants, and honestly, it just makes business a lot easier. You reduce a lot of the noise and issues that you would have to deal with in, say, lower income areas. That's the biggest thing, I think, is risk mitigation. With real estate, it's a beautiful thing because you're taking out leverage on a property. Your equity exposure, your real exposure is just the really just the equity that you put in, the down payment that you put in, making sure you have insurance on the property, right? You can actually insure a property. What other investment can you actually insure? Investing in good areas and also having the right business plan, right? That's a key piece of it. Protecting your assets. Then that's with any investment. We always recommend setting up a business structure, having an LLC for your assets. Now that exact structure may vary depending on, other things that you have, other assets and things like that. But making sure you have the right asset protection in place is really important as well. And that's where we take a comprehensive approach to try to help people not only make the best investment choices in the best areas with the best teams, but also have the right entity structure, tax structure. All these things are important into really building a successful portfolio long term and mitigating risk.
Oh, that's great. And I can tell you, the point about investing in good neighborhoods is so important because, sometimes when you see a property that's very inexpensive, you're very tempted as an individual investor to look at that and potentially purchase it because you're like, oh, look, the cost basis is so low. It's a win-win here. I'll give myself a few years and then increase rents and I'll be in good shape. But there's a reason why the cost basis is so low in some of those properties is because they're in low income areas. And, we can share so many horror stories, but this is one where a friend of mine invested in a Section 8 housing project in Washington, D.C., thinking that it was a great investment because it was such a low cost basis, but it was such a pain in the ass for him to actually manage that with the tenants, like literally just, ripping doors out for no particular reason. And, just like every time his repair guy would go in, there'd be holes in the walls. And it was a nightmare. So that's super important. The other thing that you mentioned that I really like is entity structuring, just assistance with tax issues and depreciation and things like that. Because a lot of people that, especially ones that are first time investors, they don't know how to do these things. So if you have a package that includes that, that's super helpful. Before I talk about that, you're sort of like what is inclusive in your package, I do want to talk about something that you mentioned when I was looking at your website. You mentioned like a perfect formula or, the formula to invest, and that's what you follow. What does that mean? What is that formula exactly?
So we follow what we call the ideal formula for real estate investing. And this is just the way that these are all the things we try to be conscious of and factor into our equation when we look at building wealth in rental real estate. And this is no secret sauce stuff. This is commonly known things, but we follow our ideal formula, and that's an acronym for all the ways you build wealth through rental real estate. Many newer investors, and so that's ideal. I as income means the cash flow from the property. Many newer investors sometimes just stay hyper focused on real estate as a cash producing asset, which it is, and that's fantastic. Many of our investors say, well, hey, if I want to, earn whatever, $10,000 a month in passive income, I can reverse engineer that math to say, all right, well, at $500 a door, I got to own whatever, 20 of them. And this is how I get there, right? But we always want to take time to educate them on how you truly build wealth in rental real estate. And what I've learned in my experience over many years of investing and building an extremely large portfolio is that it's all the other things that really factor into building net worth. So I is for income, D is for depreciation. That's extremely important to take into consideration. Depreciation and all the other tax benefits. We run an 8-figure business, and every single year our goal is to buy enough rental real estate, run accelerated depreciation, and offset all of our active income and create losses from there. But we're earning a significant amount of money both from our active business and our real estate, but we're offsetting that. Taxes are the highest expense we're all going to pay in our lifetime, hands down. And that's an easiest way to give yourself an immediate raise, to pay less taxes. Real estate is a beautiful tool to do that. So D is depreciation, E is equity as you're building up. So, real estate, I love the concept of where you get to borrow money from someone else, the bank, or someone else, and then have an asset that you get 100% of the ownership and the benefit from and the income, and then have someone else pay that loan off for you, right? The tenant. And so E is building equity as the tenant's paying the loan down for you. A is appreciation. All real estate goes up over time, regardless of short-term fluctuations. That's building your net worth. And then we teach investors how to recycle their equity and appreciation and reinvest that to grow their portfolio. And then L is for leverage. Leverage is something that is unique to real estate that's not available on any other asset class. It exponentially increases your ROI on all these other things, right? Being able to put a small percentage down to actually get 100% of the ownership and operation of the real estate. So when you look at that multifactorial approach and not only understand the numbers, but also actually understand how to accurately apply each one of those areas, you have a much better comprehensive view and strategy on how you build wealth in rental real estate versus just trying to buy for cash flow, while that is important. So that's our ideal approach to real estate investing.
That sounds great. Wonderful. So now you take that whole package and say somebody's interested. We have a listener that's interested in doing something like this. What is the cost to them in addition to the obvious costs of purchasing an investment property, like the loan payments and this and the normal stuff. What other payments can they expect to pay going through you guys at RTR?
We don't charge our investors anything. We make our money through building and selling houses, right? So just like any other builder or brokerage would, that's how we make our money. There's no additional costs. I mean, we do have an educational platform. If someone wanted like some hands-on kind of coaching and guidance, we do have our academy. And certainly anyone can join. That has been very beneficial, and we pay that back to them when they invest. So that's a great way to encourage them to get started. But generally, I mean, anyone can invest with us regardless of your experience level. We don't charge our investors anything. You just have the normal transaction costs. We build houses internally, but we also partner with some of the most national builders in the US because we're able to come in and negotiate wholesale pricing. And so one other benefit that investors have access to through our network is actually accessing brand new construction deals in growing markets below market value. They actually can come in an immediate equity position because we've been able to negotiate prices with builders because of our wholesale, because of the volume, right? The wholesale type of transaction that we work with. But it depends on the investor and what makes sense for them. But this is a normal real estate transaction. We match you with the right lender. It's up to you. You can use whatever lender you want to. We have a whole list of creative lending options, whether you're investing through, say, a self-directed IRA or solo 401k, if you're using a HELOC and investing through, say, a primary residence, or if you're just using conventional financing, if you're a business owner and you need, DSCR type loans, whatever the case is, we'll match you with the right lender. You get qualified with the lender. We help you identify the right property and market to match your goals. And this is through multiple conversations with our team. And then you execute on those. You go through normal due diligence of appraisals, inspections, financing, and then we set you up with a managerial side on the back end so you can own that property with minimal involvement long term and continue to focus on how to scale your portfolio. So that's generally the business plan for us. But the first and foremost thing you should do is have a consultation with our team to learn if this is even the right investing strategy for you, but also to learn about your goals, to answer your questions. And even if you're just interested to find out some resources like market data and go out and use that on your own, fantastic. We'll support that. Or if you need access to some of these credit unions that do 5% down, we're happy to share all those resources with you.
Amazing. Last question before I get to some of your interests outside of real estate. You mentioned certain areas that you're looking at. You mentioned certain cities. What are the top 3 cities that you see that are just blowing up, that are great opportunities right now?
Top 3 cities.
Yeah.
Well, this is, there's a lot of different markets that I would think are interesting for different reasons. And maybe like I could talk about my favorite, but that doesn't mean it's the right match for every investor, right? Because we really want to be intentional in matching the right price points based on resources and, things that are important to you. Some people are more focused on growth. They don't need cash flow immediately, right? But some of the areas where I think that you can get the best opportunity, I would say Southwest and Central Florida are still some of the areas. Now there has been a little bit of rent correction in those areas. We're in an interesting time because we just came out of this weird interest rate environment. We had historically low interest rates, aggressive, and we had kind of the stagnation. And anyways, where we're at today, I think 2024 is positioned for a very strong growth position in the right geographic markets. So we like the Southeast areas around Huntsville and Birmingham. I mentioned those previously. Huntsville is an area that people hear about all the time. You got NASA, you got the government there. There's just a lot of tech going into Huntsville. Huntsville itself proper is very expensive. That would definitely be on the radar. I like areas in Southwest Florida, like Cape Coral. That's a growing area. Texas, even though Texas has higher property taxes, they also have some really strong growth areas where you can still buy a new construction house in the $250,000 to $300,000 range that's going to actually produce positive cash flow. Let me say this too, Ravi, with just in general, we try to be below the mean, and this is important to understand in our approach to being in areas where we get the highest demographic for tenants, also resale buyers, because our average client will hold a property for 4 to 6 years and then they'll sell it because they've grown enough equity through appreciation and debt pay down. And it's time for them to sell in 1031 exchange and scale up. And so that's kind of the approach. Some people may think they're going to own a property for 30 years and have it be paid free and clear. While you can do that, scalability is important, but we like to be below the median house price point, which is $408,000 right now. We were just looking at statistics for affordability, and we mentioned the $7.2 million or 7.2 million houses under supply of housing in the U.S. right now. The majority of the houses for sale right now, 40% of those are $500,000 or above. Only 15% of those are $300,000 or below. And the US has come out and stated that the average affordability for home owners is $275,000. And so that means that the vast majority of Americans cannot afford to buy houses, and they're renting. So we want to be in areas where we're providing that for that supply for housing. So we want to be in areas that also are affordable. There's a lot of great markets where you can have high income on properties, but it's also $1 million house. And that takes a significant amount of money down. So we want to be, the sweet spot is at 250 to 350 range of brand new construction, single family, and a lot of pocket markets in the Southeast, especially secondary markets surrounding like Polk County outside of Orlando. Those are some really hot areas where there's a huge undersupply of housing. So I don't know if I answered your question too indirectly, but
you did. No, that was a good answer. I appreciate that. And I find this is a very interesting type of investment strategy. I mean, especially if someone wants to get more active in their investments, if someone's interested in just getting, just being very passive, and just, submitting submitting an equity investment and just getting a nice return and taking advantage of depreciation, multifamily is the way to go, especially if you're focused on residential type real estate. If you're thinking that you want to be more active, you want your own complex, I feel like, Zach, your product makes a lot of sense. So before we conclude, prior to starting the podcast, we were chatting a bit, and I found it really interesting in that, you've achieved a good amount of financial freedom, or complete financial freedom, it sounds like, given your what you're doing. So you have the time and energy to put into other types of activities, and you mentioned one of them being international work. So maybe you could just share with us before we end what your other interests are aside for real estate.
Yeah, certainly. And I love to talk about this stuff because, sometimes it gives me goosebumps and brings me back to the why, right? We all got to have the why. I think a lot of people, when they first think about real estate, it's different to different people, but I think people are drawn to the idea of real estate because it's a tangible asset. They have control over it. They're not subject to the volatility of stock markets and things like this. I mean, I don't know about you. I've never met with someone who successfully retired off a 401k and the solely stocks, but maybe I'll meet them someday. Yeah. But real estate is unique because there's a lot of different ways you can invest it in. I think people are drawn to it because they want to have some control over their financials and like some sort of like financial freedom, right? When we started investing in real estate, why I started investing in real estate is because it was simple. I'm a simple person and I like simple math and I like tangible results. And so I was able to kind of just see, hey, this is a unique concept. By no means did I have the ultimate goal to like be at the point where we're at today, but I just kept investing, and it took many, many years. But we were able to replace and surpass our active income, and then actually build this business and do significantly more. Sometimes people will come to me and they'll say like, oh, I'm so glad that you found your passion and realized that like eye care wasn't right for you. And I always stop and correct them because that's not accurate. I'm very passionate about helping people see. And because I had terrible vision as a kid and multiple surgeries, and so did my wife. And, that's an important thing for us. But now we're able to have such a larger impact globally through humanitarian efforts doing eye care, right? And this is two main ventures we have. Our humanitarian efforts are establishing international cataract clinics where they're sustainable, ran by local docs and clinics and locally funded once we start those up. And we also are very passionate about helping children have access to eye care and corrective lenses that don't have access to immediate eye care. Cataract surgery, if there's any ophthalmologists out there, that's just everyone gets cataracts, and it's just a simple way to correct people where they can actually see, otherwise they go blind, long enough. And also kids having the ability to actually see and learn. And so we've been able to, because we have higher income, still give back and serve humanity in general through eye care, humanitarian efforts, without having to be reliant on eye care for our income, being in the chair every day, seeing patients. And that's just been like such a rewarding experience for me that real estate has made possible that we never would have imagined we would have been able to do. We just started investing in rental real estate and just kept doing it, right? And then helping other people accomplish their real estate investing goals as well. It's just kind of all comes full circle. So I'm very passionate about real estate and what it can accomplish for people over time.
Right. That's amazing. I love that. And, the why is ultimately important. It's what drives you. And, most of us that invest in real estate, the why isn't, I want to be the best property manager, asset manager ever. It's not, it's typically not that. It's you have other goals, other passions, and you're investing to realize those other goals and other passions. And, your platform helps people do that. So that's wonderful. If people want to get in contact with you, Zach, or learn more about what you do, how would they do so?
Yeah, as I mentioned, the first step is just to have a consultation with our team, learn about your investing goals, share resources with you. My goal with our team is always to add value to every person that we come in contact with our knowledge base. And so I want everyone to walk away with at least learning something that they can apply to their own investing. But if you're interested to learn about those resources, connect with us, see if turnkey investing with rent to retirement is the right approach for you. Best thing to do is always go to our website, because we have our own podcast and YouTube channel. We put out a ton of information about creative finance and all the things out there that you benefit from. Our website is renttoretirement.com. That's renttoretirement.com. If you're listening to this in the vehicle, when you're stopped and safe, you can text REI to 33777 to get on our email dispo list, and we'd be happy to connect with you and share our resources.
Awesome. Appreciate it, Zach.
All right. Thanks so much for having me, Rob.
If you like this podcast, please hit subscribe or a thumbs up, and we'll see you next time.